Welcome to PIMCO Pod. In this episode, we discuss slower U.S. job growth and likely economic cooling, along with the implications for Fed rate cuts. Stay tuned after the conclusion of the podcast for additional important information. Downshifting to neutral. Labor market revisions spark fears of slower growth by Allison Boxer and Graham Westwood. The July non-farm payroll report missed expectations, with hiring slowing to 73,000, well below the Bloomberg consensus of 105,000. However, the bigger surprise was a sharp downward revision of 258,000 to job gains over the prior 2 months, painting a markedly different picture of the U.S. labor market. Bond markets, which had reflected the lack of guidance on the outlook for rate cuts at the Federal Reserve's meeting 2 days earlier, quickly repriced expectations. As a result, 2-year U.S. Treasury yields dropped about 27 basis points, BPS, during the day. However, we believe the revised labor market data points to a cooling economy, not a collapse. The revised pace aligns with growth closer to 1% to 1.5%, down from nearly 3% in both 2023 and 2024. Last week's GDP report confirmed that real consumption growth slowed to 1% in the first half of 2025, compared to nearly 4% in the second half of 2024. The jobs report reinforced signs of deceleration due to numerous headwinds. Tariffs are resulting in trade sector layoffs. Government layoffs are continuing. Softer consumption is translating to weak leisure sector hiring. And immigration policy changes are affecting both labor supply and demand. The pace of hiring has slowed, particularly in more cyclical, economically sensitive sectors. After revisions, the 3-month average for payroll gains stands at just 35,000, down sharply from 232,000 in January. Hiring in cyclical sectors has essentially stalled, with job growth concentrated in less cyclical sectors such as healthcare and education. The bigger news from this report was not the pace of hiring in July, but the large negative back-month revisions. While labor market data is typically revised over time, the July report featured one of the largest 2-month revisions outside of a recession, especially when adjusted for the size of the overall labor market. Historically, revisions have tended to be larger around economic turning points, such as recessions, and upward revisions were common during the post-pandemic recovery. The July revisions prompted the White House to fire the chief statistician in charge of compiling the data later that day. Why do these revisions occur? The BLS's initial monthly payroll estimates rely on incomplete responses from firms and statistical assumptions that account for things such as firm creations and closures. As more data becomes available in subsequent months, revisions are made. A more comprehensive annual revision, based on state tax records, is also conducted. Preliminary data from the quarterly census of employment and wages suggests this year's annual revisions could be significantly large and negative. Fed Chair Jerome Powell warned in last week's press conference that this could be coming. The BLS is scheduled to release preliminary annual revisions in early September, just before the Fed's next meeting. The revisions could again suggest that the pace of hiring was weaker than previously thought, something officials may factor into their outlook for the path of interest rates. We believe the slower pace of hiring also reflects changes to U.S. immigration policy, a fading tailwind we highlighted earlier this year. See macro signposts. U.S. labor market faces tighter immigration policy. U.S. immigration surged in the post-pandemic period, and we think this was a strong contributor to the total pace of hiring over the past few years. However, policy changes, first by the Biden administration and more recently under Trump, have notably slowed the pace of immigration into the U.S. over the past year. Slower population growth should be consistent with the lower steady-state pace of hiring, and we expect non-farm payrolls to continue to remain more muted in the second half of this year as a result. Less immigration and slower job creation are also affecting GDP growth. Income growth has slowed amid lower job creation and slower population growth, leaving fewer people to add to consumption or employment. Last week's GDP report showed real consumption grew just 1% on average during the first half of 2025, consistent with the slower pace of hiring. This suggests that labor market signals and GDP data are now telling a more consistent story about the cooling U.S. economy. Immigration and U.S. demographics are also affecting the unemployment rate. Despite disappointing non-farm payroll data, The unemployment rate rose only modestly in the second quarter of 2025 to 4.2%, little changed over the past year. We believe lower immigration and aging demographics are reducing labor supply, keeping the unemployment rate steady even as labor demand declines. An alternate scenario, where immigration and retirements did not affect labor supply, as measured by the labor force participation LFP rate. In mid-2024, the unemployment rate would have been lower, all else equal, and the rise in unemployment rate that was part of the justification for the Fed to cut 50 BPS last September may have been less pronounced. Similarly, if the LFP had not declined recently, the unemployment rate would have risen more notably this year. Powell mentioned the effects of reduced labor supply several times in his recent press conference. The labor market may remain balanced amid a slowdown in both labor supply and demand, resulting in the unemployment rate staying consistent with the Fed's maximum employment mandate, even if payroll gains decline. But because it's impossible to know fully what is driving the labor market or where it is going, the Fed remains focused on risks. Indeed, Powell flagged downside risks to the labor market 6 times in his press conference. We think slower labor demand suggests downside risks have risen, and we expect the Fed to resume rate cuts this fall. Thank you for listening. That was Downshifting to Neutral. Labor market revisions spark fears of slower growth. For future insights, please follow us on your favorite podcast platform. Macro Signposts highlights weekly takeaways from the data analysis conducted by our team of economists and other macro experts. For PIMCO's official views on the global economy, please visit PIMCO.com. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need, and it is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcast may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.